Welcome to the City of Ann Arbor Employees Retirement System and Retiree Healthcare Benefit Plan and Trust update for City Council. In lieu of appearing at a work session, we are recording this for you to view at your convenience. My name is Wendy Orcutt. I'm the Executive Director of the Employees Retirement System for the City of Ann Arbor. And joining me today are Jim Anderson and Rich Koch. They work for Gabriel Roeder Smith and Company, the pension systems actuary. We're going to run through a brief update for you, and at the end, I will share a couple comments that were provided by the systems investment consultant, and we hope you enjoy the update.
Thank you, Wendy. I'm Jim Anderson. I'll take over for the first half of this presentation, and I'd like to start with what we call a 30,000-foot view of retirement plan financing. This applies to the pension and the VEBA equally. And you might wonder what we do as actuaries. Rich and I are part of a team serving Ann Arbor. And what we do as actuaries is mathematically combine the people data, which you'll see is the demographic information box below this on the lower left-hand side, along with the benefits, which is called plan provisions, our assumptions, our important actuarial assumptions, another box over the circle of the actuarial valuation, and finally, financial information, which is basically the assets. We combine all this with the funding policy of Ann Arbor, which is distinct to Ann Arbor, to produce actuarial valuations of both the pension and the we have millions of calculations that are involved in this work of preparing the actual evaluation, and we try to drill down to something that's digestible for folks who are making decisions at the board and city level. That includes employer contributions, the funded status of the plans, any unfunded accrued liability, which is the flip side of that funded status, and of course, all this done with a mind towards how Ann Arbor is planning to fund the plans. So let's start with the people. We show demographic information as of June 30, 2021. You see the active members in the left-hand box. There are about 707 active members currently working for Ann Arbor as of June 30, 2021, with an annual payroll of $55-some million. We have a note here that there are hybrid members that have a benefit equal to literally half the defined benefit accrual rate, as well as a defined contribution component that is made for those hybrid members. And you can see that within the general group, this is a large and growing number, 184 general hybrid members as of the valuation date. For police and fire, a little different story, just one member each in each of those divisions based on employee classification. Moving to the right, the upper right, we show the retirees and beneficiaries as of June 30, 2021. And we've got about 1,121 members who are receiving benefits as retirees. This is the whole reason we do the valuation. We want to make sure there's sufficient funds available to pay the some $40 million annually you see on the chart to our retirees and beneficiaries. That money goes to the retirees and beneficiaries and then goes out into the local economies where they live, providing a jolt to Ann Arbor to some degree and wherever else they live. You can see we've got 716 general folks, 228 police retirees, and 177 fire retirees. Lastly, for people member data, we've got our inactive members eligible for deferred benefits. Who are these folks? Well, these are people who used to work for Ann Arbor, but have a vested right to a benefit sometime in the future. You can see there's about 105 people here with estimated annual balances of yet another $1.6 million that when they retire will go to them and then flow out to the economies in which they live. Moving to plan provisions for the retirement system and the VEBA. Starting with the retirement system at the top, we've got defined benefit elements. What does this mean? This means this benefit is defined. It's a certain percentage that's applied to compensation applied time service that folks earn during their working career at Ann Arbor. As I mentioned on the previous page, there's a hybrid benefit element to Ann Arbor, which is that reduced defined benefit accrual plus a defined contribution amount. And in either case, member contributions are required to participate in the system. With respect to the VEBA, we've got folks with retiree healthcare coverage equivalent to the coverage they received on their date of retirement if they were hired at selected dates from 2011, 2013. For folks after that date, there's an annual contribution ranging from $2,500 to $4,000. It's made to a notional account. And lastly, we have a life insurance death benefit of $10,000 for all the retirees in receipt of a city pension. I said we talk about assumptions, and the most important assumption, the investment return assumption. We certainly review all the other assumptions with the board as a part of our experience studies every 5 years. But importantly, this really crucial assumption, which is the discount rate that's used for valuing plan liabilities, it's called the assumed rate of investment return, changed from 7% to 6.5% over a 5-year period. The board adopted this with the 2020 valuation analysis and said each year we'll look at this and have a 10 basis point decrease each year. And we'll confirm that each year. That's another important part. We don't want to overshoot necessarily in light of this period of growing inflation and other things that happen in the economy. So each and every year, the board is going to review this reduction and make sure it makes sense for the time being for the next valuation. So important to note, the last point, 6.8% discount rate was used in the 2021 valuation results that Rich will walk us through. And lastly, I'm going to talk about financial reporting for retirement plans. The second bullet is talking about the actuarial standards of practice. This is governing our funding valuations. Also, a lot of those calculations flow into the accounting as well. I want to make sure that those funding valuations are performed by an independent professional actuary. That's Rich and I and our team who do that for Ann Arbor. We use our funding valuations to determine what's called the actuarially determined contribution that Rich will review in a moment. And it's important to note that these funding valuations reflect less volatility due to amortizations amounts that are different, rolling amortization, a smoothing of asset values, perhaps the most crucial. We'll point that on our slides, relative to what's reported for accounting standards. Now moving to the top of the slide, on the accounting basis, under GASB, those standards have been modified to reflect market values of assets and liabilities. So the important part here is we reflect market value of assets in our accounting numbers, smooth values of assets in our funding numbers in order to get more budgetary consistency. The results of the GASB reports are incorporated in the city's financial statements. How are they incorporated? Well, there's something called the net pension liability, which is basically your assets minus your liability that's reported on the balance sheet. There's also something called the pension expense, which goes onto the income statement of the city. And each year, these valuations for accounting purposes will reflect the volatility of the financial markets, since we use a market value of assets on June 30 of each year. And you'll see that in the results that Rich will be reviewing in a moment. With that, I think I'm passing it on to Mr. Cook. Oh, one more thing. Yep. Last, we'll talk about accounting standards. I'm ready to give it to Rich too quick. So there's the text here is really talking about accumulating those funds that I talked about on that page with the retirees. What are we trying to do? We will make sure there's enough money to pay for retirees' benefits when they retire. We gather employer and employee contributions, put that in a trust. The trust earns investment income. Rich will talk about that in the next slide. We've seen certain clients that have said they pay 2/3 to 3/4 of the benefits to participants out of investment income. So that's the whole key of our defined benefit plan. When the value of investments in the trust are less than the value of the benefits, the fund is called less than 100% funded. And that was a more salient note in past years. You'll see that on this market value basis at June 30, 2021, with the market run-up, the pension is funded at 100.2% of the current pension liability, looking at the accounting standards, so on a market value basis. And that compares to the last 5 years. We were in a really narrow range from 84% funded to 88% funded. And now we've seen that volatility we talked about, bumping that ratio up to 100%. The healthcare on the right-hand side, city has funded about 78% of the retiree healthcare liability. And similar to the pension, but different, you can see that we've been in the 51 to 67% range the last 5 years before jumping up almost to 80%. Clearly, if we have a market correction, that will result in these numbers reducing going forward. And with that, I think I now do pass it on to Rich. Rich, take us away.
Yeah, great. Thanks, Jim. So this particular slide focuses in on this retirement program sustainability equation. As Jim mentioned earlier in his portion of the presentation, there are currently just over 1,900 total plan members in the employees' retirement system. And ultimately, the goal is to ensure that we can pay promised benefits when they come due. And in order to do that, this sustainability equation has to hold true long term. So just going through this equation, we have C plus I, that is contributions plus investment income, has to be equal to B plus E, benefits plus expenses. To say it a little bit more succinctly, money that comes into the plan has to equal money going out of the plan long term. Taking a look at the benefits, what do benefits depend on in the retirement system? Well, first of all, we have plan provisions. Jim alluded to this a little bit earlier. Retirement eligibility requirements. We've got benefit formula and things like that come into play in terms of determining benefit levels. In addition to that, we have plan experience. So how long are people working? What do their final average pays look like when they do start collecting benefits? Higher pays will obviously result in higher benefits. On the VEBA side, this B part of the equation is a little bit more volatile, much less predictable because the benefits on the VEBA side are based on retiree healthcare costs, and there's a lot more volatility in those. When looking at the contributions, as Jim said, that is really our primary role as the actuaries is to go through the valuation process and come up with a contribution amount that we believe, if invested into the plan trust, will be sufficient to grow and be able to pay future benefits. And so in the short term, contributions depend on actuarial assumptions and cost method. In other words, we go through our valuation process that utilizes the assumptions, utilizes the cost method, and we arrive at what's referred to as an actuarially determined contribution. I'll refer to that as the ADC moving forward in the presentation. But ultimately, in the short term, that's how contributions get calculated. But really, over the long term, as you can see in the equation, the amount of contributions that are required will depend heavily on the I portion of the equation, the investment income. To the extent that the investment income exceeds expectations, that will serve to put a little bit less pressure on the contributions. On the flip side, if the investment income is less than what we assume, then obviously that's going to put upward pressure on the contribution amounts, all else being equal, to make up for any gaps in expected investment income. And obviously benefits and expense levels also do have an impact long-term on what those contribution levels are going to look like. The next slide, we're going to kind of look at the highlights here of the June 30, 2021 valuations of both the employees retirement system and the VEBA. I'm going to start on the employees retirement system column here. So the first line item, the actuarial value of assets as of June 30, 2021 is $554.1 million. As Jim alluded to, this is a smooth value. So this does not reflect full market gains and losses immediately every year. Rather, we phase in gains and losses over a period of future years. And as Jim said earlier, what this does is it reduces the volatility in the value of the assets used to calculate contributions. And when you reduce volatility in the assets, you by default will reduce volatility in the contributions being calculated as well. We have a total actuarial accrued liability as of June 30, 2021 of $627.1 million. That should be thought of as the liability allocated to service already worked for all participants. So for retirees, beneficiaries, terminated vested members who've already earned their full benefit, their full liability is included in there. For active members, the portion of their liability that is attributable to service that they've already worked is included in that $627.1 million. So the only piece of the full pie that's really not included in that actuarial accrued liability is what's referred to as the future normal cost for active members. And what all that means is it's a portion of liability that is attributable to future service that they're expected to work. I'm going to come back to that idea of normal cost here momentarily. The unfunded accrued liability of just over $73 million, that's just the difference between the total accrued liability and the actuarial value of assets, is just over $73 million as of the valuation date. And then ultimately we get down to the fiscal year end 2023 ADC of $14.3 million. That $14.3 million is made up of two components. One component is to pay off that $73 million in unfunded liability. We financed that over a period of 20 years as of the 2021 valuation date. So that's the first component. The second component of the total actuarially determined contribution is referred to as a normal cost contribution. And what that does is we look at the current active population. We say how much of their retirement benefits do we expect them to earn in the next year? And we make sure that we contribute that amount into the trust as well to ensure that we're maintaining funding pace of funding for current active members. So when we combine the unfunded liability portion of the contribution with the normal cost portion, we end up at a total contribution of $14.3 million. As of the valuation date, the funded ratio is 88% on an actuarial value of assets basis. That's up from 85% in the 2020 valuation, primarily due to favorable investment income that we saw in fiscal year 21. And the last row here shows that we have a projected year to attain 100% funded status of 2025. A couple caveats to that year. Number one, that is based on the accelerated funding policy and the expectation that funding policy will be adhered to in all future years. It also assumes that plan assets will earn the assumed rate of return of 6.8% in all future years. The last thing I'll mention on that, the idea of becoming 100% funded, all that means is that unfunded accrued liability at that point in time is expected to be zero. But that doesn't mean we don't have future contributions, because as I already mentioned, we still will have an ongoing normal cost contribution for any current active members in the plan. Shifting over to the VEBA column here, I'm going to run through this a little bit quicker since I've provided an overview of kind of each line item when going through the employees retirement system results. We have $219.5 million in actuarial value of assets, $290.1 million in total accrued liability, which results in an unfunded accrued liability of $70.6 million. The funded ratio on an actuarial value basis is 76%. That's up from 65% in 2020. You might be a little bit surprised to see that big of a jump in the funded status. I know on the pension side, I said they went from 85 up to 88. So why such a big jump on the VEBA side? The short answer to that is we did have favorable investment experience, but we also had favorable claims experience. And so the favorable claims experience served to reduce liabilities below expectations. And so really the gap between liabilities and assets closed much more on the VEBA side due to that fact. And our projections show a 2027 is the year in which the VEBA is projected to be 100% funded. Again, that comes with the same footnotes as the employees retirement system, the accelerated funding policy, assets earning 6.8%. And again, that does not mean no future contributions will be required, because we will still have the normal cost components coming into play. The next couple slides are designed to really give the council an overview of where the City of Ann Arbor retirement system falls relative to other Michigan city and county plans. The first slide here highlights the funded status. You'll see on this slide, Ann Arbor's retirement system falls right in the middle bar there with 14 plans at 88% funded. That bar is 80% to 89.99% funded status. Obviously, Ann Arbor's at the upper end of that scale. We do, because of the smoothing characteristics of the asset values, we do have some expected investment gains to be recognized in the next couple valuations, barring any offsetting losses. And so it's very possible that when we go to do the 2022 valuation, we might even see an uptick over that 90% threshold for the retirement system. You can see that middle bar where Ann Arbor lies is pretty much right in the middle of all the different plans. We've got 40 plans that are less than 80% funded, and we've got 37 plans that are actually over 90% funded, with 9 of those being over 120% funded. One thing to note on those plans that are over 120% funded, from a funding policy perspective, that's really not, the goal isn't to become as overfunded as possible, because while that does provide a certain level of benefit security for plan beneficiaries, there are other implications of having excess assets locked up in the retirement system. As we go to the next slide, this is a comparison of the investment return assumption among Michigan city and county plans. Again, on this particular chart, Ann Arbor does fall directly in the middle here as well, in the bar with 13 plans. That is from 6.75% up to 6.99%. Jim had mentioned earlier the retirement board's policy to look at this assumption annually and to reduce it by 10 basis points each year until we get down to an ultimate rate of 6.5%. And so based on that policy, when we do the June 30, 2022 valuation, assuming that policy is still in place and is adhered to, we'll actually be at 6.7%, which would actually bump Ann Arbor down even more in terms of where we're at on this graph. It would bump them one bar to the left. Other thing I'll point out here, really it's more of a general theme that we're seeing in the public sector is we're kind of seeing a mass exodus of these plans that historically were, 7.5%, even some plans at 8% investment return assumptions. All these plans that are up over 7%, we're really seeing an exodus of these plans going down into the sixes, really kind of transitioning and lowering that assumed rate of return. And that is just due to the fact that investment consultants are looking at forward-looking investment expectations, and those return expectations are lower than they have been historically. And so in turn, though the long-term investment return assumptions on an actuarial valuation basis are also being reduced in line with those market expectations. We're going to shift gears here now on the next slide, looking at the VEBA funded status. We're looking at this from a Michigan Public Act 202 perspective. Just a little bit of background on that. Michigan Public Act 202 requires all local units of government to report both their pension and OPEB results on a uniform assumptions basis. And so this information was readily available. And so we're using this for comparison's sake here on the Ann Arbor VEBA. Ann Arbor falls into, the VEBA is 72.9% funded currently. And so you'll see we fall in the 51 to 75% bar with 35 plans. You know, important thing to note here, there's 186 plans that are less than 50% funded. You know, and of those 186, there are 59 plans that actually have no assets set aside to pay for future retiree healthcare costs. So what is the story being told by this graphic? Well, part of the story is the fact that, you know, this idea of pre-funding OPEB benefits or retiree healthcare benefits is somewhat of a newer concept for plans. Many plans were on a pay-as-you-go funding policy for a long time, and I think they're starting to realize that for long-term sustainability, it's better off to get ahead of these and pre-fund these obligations. I think the other important thing to note here is that Ann Arbor is well ahead of the curve here in terms of their funding obligation and funding the VEBA. The next slide just kind of puts into words what I've already kind of summarized here from the previous slide. Ann Arbor is ahead of most local units in terms of the funding obligation on the VEBA. As I said, they're at 72, or we're at 72.9% funded. The average funded percent from based on Michigan PA 202 is 42.9%. The median funded percent is 26.6%. We did remove a couple of outliers there that were skewing the calculation of those statistics a little bit. But nonetheless, I think the story on this particular slide is that Ann Arbor is ahead of the curve. And given their risk management strategies in place, I anticipate we will remain ahead of the curve when it comes to funding the VEBA. As I said on the previous slide, we have nearly 23% of reporting entities have no assets currently set aside for funding retiree healthcare obligations. And I'll wrap up my portion of the presentation here looking at some of the risk management policies that are in place currently to help mitigate some of the risks that the employees retirement system and the VEBA face. And so from a board governance perspective, there are several prudent practices in place. As Jim alluded to earlier, we do perform an experience study every 5 years to review actuarial assumptions. We also review the funding policy contribution at least every 5 years. Currently, that policy allows for contributions in excess of the actuarially determined contribution. And really having a sound funding policy in place will provide for contribution stability as well. There are also declining amortization periods for both the pension and the VEBA. When I say declining amortization, what I mean is currently as of June 30, 2021, that unfunded liability is being financed over a period of 20 years. And that period is expected to decrease in each subsequent valuation until we hit a 15-year amortization period. Finally, the use of level dollar amortization is unique for funding public sector retirement benefits, particularly given the fact that the city of Ann Arbor's plans are both still open to new hires. Generally, in those circumstances, we'll see a level percent of pay amortization policy, and the level dollar amortization policy is unique in that respect. Additionally, Jim already talked about these a little bit earlier. There are some plan design features that have been implemented to help mitigate the liability growth and risks surrounding liability. In particular, there's a dual plan approach. In other words, the hybrid approach that Jim talked about, where new hires have half of their benefit is defined benefit, half of their benefit is defined contribution, and the defined benefit portion of their benefit is lower than traditional plan members. In addition to that, there have also been plan design features such as transitioning from a 5-year vesting period to a 10-year vesting period, and transitioning from a 3-year final average compensation period to a 5-year final average compensation period. Again, all of those plan design features have served to reduce future liability growth and the risks surrounding that growth. On the VEBA side, there are new benefit tiers for all members or for people hired after certain effective dates where they get a level dollar contribution as opposed to an actual city paid retiree healthcare. And all of those policies will serve to ultimately reduce the contributions and improve stability surrounding those contributions when compared to historical benefits. And with that, I will hand it over to Wendy for some investment highlights and to wrap us up.
Thank you very much, Rich and Jim. That was excellent. As Jim mentioned earlier, you really can't overstate the importance of investment income to the plan. And just a few highlights here. Fortunately, the last fiscal year end returns were just amazing. And even at the end of this calendar year, the ERS returned 17% and VEBA returned about 16% net of fees for that period. And I feel like it's important to note that there's been a lot of activity with the board lately. You know, Jim mentioned the return assumption. So every year, the investment manager, Nikita, represents the system, will give us their projections on what they feel the yields are going to be on a long-term basis. And given the projections from the capital markets, we realized that the portfolio wasn't structured to possibly keep achieving that. Therefore, they approved new asset allocations for both. And in the last several months, to that end, new managers have been added to fund these new type of strategies that will hopefully continue to achieve the investment return that we need to sustain the system. If you wouldn't mind flipping to the next one, Rich. Thank you. These actually are just a couple stock items that were in last year's update as well, that the system and VEBA both have a very well diversified portfolio. I just mentioned the asset allocation. There's a lot of alternative investments in there, risk mitigating strategies, and also very important to note, the cost for the system are quite low compared to the peer universe of what we pay for investment fees. So that's obviously important as well. You got to make money, but you don't want to spend too much of it either to achieve those returns. And with that, I will again thank Jim Anderson and Rich from JRS for providing this update. And thank you to the council.